कोई बाई और सेलिंग एडवाइस नहीं है। अगर आपको ट्रेडिंग करनी है तो अपने फाइनेंशियल एडवाइज़र से कंसल्ट करके ही करें। एंड आई एम नॉट अ सेबी रजिस्टर्ड एडवाइज़र।
So how you are feeling? You are feeling bored, or you are feeling like it's good, or so?
No,
Feeling.
something new, sir. So it'll take some time to adapt, I guess.
Yes, it will take time. But these things are very new to the people. They will most of the things I have seen from the kids. They will start start learning. They are taking the interest because this is a very new thing, right? And more or less, the more practical knowledge you will get, then you will feel a lot of interest. Now I'm just telling you about the theory and the slides, right? But soon, like after 4 or 5 classes, we can start doing something practical also, right? Once you have the demat account, then you will get a lot of interest to do it.
Yes.
So this is clear, right? Okay. So this is one slide that you can take a look, and after taking a look, can you tell me what is happening in this slide, or what you understand from this slide?
Okay. It is the way you need to divide your capital into, like,
Yeah.
spend it in 50%, save it, and invest it.
Right. Okay. So this is how this chart talks about the types of capital, right? We have, see, there are two types of ways you can earn money from anywhere, right? One is skill based, and other ways finance or money based, right? So there are two ways you can earn the money based on your skills. Let's say you are giving an exam in IIT, right? So once you got selected, you will study for 4 years, right? So in 4 years, you will learn some skills, right? So those skills you are going to use in your job, right?
Yes.
So from job, you will earn money. So that is basically a skill to earn the money from the job, right? Second thing is, let's say you have done the skill, you have completed your 4 years, and now your father give you 5 crores of money. Okay, now he want you to start a business, right? Now you are going to start a business, or maybe you start doing the investments or trading in the stock market with 5 crores of money, right? So that you are using to earn the money, which is called as finance based skills, because you are using your money to earn money.
Okay.
Your input is also money and your output is also money, but here your input is skill and your output is money, right?
Okay.
Here your input is also money and your output is also money.
Got it.
Right. So there are two types of things that you can earn the money: skill based and money based. Right. So this is the human capital. We call it as a human capital. You work for money, job, salary, and this is called as asset capital. Your money works for you. Right. You have your money. You will invest in real estate or stock, whatever it is, and then you earn some capital gains, or you earn some dividends, or you earn some profits. Right.
Okay.
Right. So like me, if you take me an example, I'm using 20 to 25% my skills to earn money, like I'm taking trainings and all, right, and remaining 75 to 80% I'm using my money to earn more money
Okay.
from the markets. So if you divide my thing, then it is 20 to 25% comes in the human capital, and remaining will come under asset capital, right?
Okay.
So now from these two ways you are earning money, right? So that is called as cash flow, means you are getting money from different sources, right? This is called as cash flow. So now there are three ways to use your cash flow, right? You can spend it, right? You can save it, or you can invest it. Most of the people know these things. Most of the people, like 95%, 90 to 95% knows about these two things: spend it and save it. But what they are going to do is that they are splitting like this: 70% and 30%. They mostly do like this. They will not invest because they don't know what is investment. They don't know what is investment, right? They will save the money. Either they will keep it in savings account, or they will keep in their home, or sometimes they will keep it in FD and RD. FD and RD is also called as an investment, but it is not that much of investments, right? Mostly the investment will be called as the real estate, gold, commodity, or stocks, right? So most of the people know how to spend it, right? They know how to spend it. They can spend it on vacation. They can spend it on buying the new cars, right? They can spend it on going outside to eat food and all, right? But they don't know about the investment. So our actual split should be 50% spend, 20% save, and 30% invest. Right? Means if you are earning 1 lakh per month, that is how you have to split. 50% you should spend it, 20% you should save it, and 30% you should invest it. So spending is fine, investing is fine, but what do you understand by saving? Why it is important? Why we are giving 20% to saving?
Just in a case of emergency or
Yes, correct. So we have to keep this money as an emergency fund. So either you can keep it in some bonds, which are called as government bonds, right? Or you can keep it in FD, or some money you can keep it in savings account. Wherein, if you want the money, you can withdraw it immediately, right? Because if you invest this money, it is not important that you may get it at the same time, right? So that is why saving it is very important in terms of emergency fund, right? So one person should have minimum 3 to 6 months of emergency fund with them.
okay.
Let's say you are earning 1 lakh per month, then you should have at least 6 lakhs, 5 to 6 lakhs in your emergency fund. Fine, this is clear?
Yes, sir.
Okay. Apart from that, one must have a health insurance and term insurance.
Okay.
This also is a part of saving actually.
Okay. What is term insurance?
Term insurance basically kind of life insurance. The person is taking.
Okay.
Health insurance is taking like to safeguard their health and all. See, let's say if some people has got some disease or he has to get admitted in hospital. If he doesn't have a health insurance, then he has to pay from his pocket, right? But if you have a health insurance, then health insurance can pay on your behalf. The 70 to 80% bills they will pay. Only you have to pay remaining 20 rupees, but 20%. But if you don't have health insurance, you will end up paying all 100%, right?
Okay.
So that is why health insurance is also very important and term insurance is also very important. Right?
Once not in use, we will get the money returned.
No, health insurance is basically for the health, right? You have to keep it for your till you are alive, because you can fall ill. One person can fall ill at any time, right?
Yes.
So that is why health insurance has to be there till whole life, actually.
Okay.
Right? Because if some huge medical expenses will come, then how you will pay from your pocket, right?
Okay.
So for health insurance, you have to pay some premium every year to the insurance company. So that is why they will give you some assured of insurance like that, right? Same thing is term or life insurance. So this is the insurance against the life, right? So here also we have to pay the premium every year. Fine, this is clear.
Yes,
so
sir.
spending, saving, and investing, right? So now investing. So here we are going to talk about only the stocks, how to invest in stocks, right? So stocks are of different categories. Like every human behavior is different, right? Similarly, every stock is having a different behavior, or every stock is having a different business, right? So different categories of stocks: growth stocks, dividend stocks, blue chip stocks, cyclic, defensive, and speculative. So these are the 6 category of the stocks, right?
Okay.
Any idea you can tell me about from the names, what could be the growth stocks, what could be the cyclic or
Might be like it is always in profit, or the market is being expanded on hourly basis, daily basis.
This is not actually in terms of stocks. It is not like hourly or daily. This always comes in quarterly, because the company declares results every quarter, right?
Okay.
So every quarter we will come up to know about the how was the sales in the previous quarter, how much profits they have made. All those things will come in each quarter result. So that is how we can identify the growth stocks, right? Normally, the stocks which are a part of Nifty 50, we call it as a growth stocks, because the SEBI they'll take all the stocks in Nifty 50 which are continuously growing, right?
Okay.
Filter the stocks based on that, like Reliance Industries, HDFC Bank, basically top 50 companies of India. So they comes under the growth category because they are continuously growing from long time and will continuously keep growing also in future, right? If SEBI sees any of the company is not performing well from Nifty 50, they will remove that stock from Nifty 50 and they will add a new one. Fine.
Yes, sir.
So dividend. So any idea about dividend?
No, sir. Maybe that stock is not owned by one person.
No.
I mean, that company is not owned by one person.
Dividend is a kind
Many
of
people.
company. Let's say company has earned some profit, right? So they will give some money to their shareholders in the form of dividend. They will share their profits to the shareholders in the form of dividends. Let's say a stock is of 100 rupees and the company got good sales and good profits. They can share 1 to 2 rupees depending on the profit sharing. They can share 1 to 2 rupees per share to the shareholders, right? And if you are holding 1000 shares of quantity, then you will get a dividend of 1000 rupees.
Okay.
Right. So this also is a part of passive income. Some people opt for dividend stocks only so that they can earn passive incomes every quarter or every 6 months or every year, right? Because some companies declare dividends every quarter. Okay. So they have to share their profits with the shareholder. So blue chip. Any idea about blue chip companies?
No, sir.
Okay. Blue chip companies are mostly the kind of growth companies, but these are the large cap companies who are having the large capitalization, large market capitalization, like for example, Reliance, HDFC, State Bank, ICICI Bank, right? These are the top companies which are called as blue chip or large cap companies. Right?
Okay.
Cyclical companies, any idea about cyclical companies?
No, sir.
Cyclical company means like every year, every 2 years, or every 3 years, or every 5 years, if their phases are coming at that time, the demand and supply. Based on the demand and supply, these stocks are performing actually. Cyclical stocks are called as based on the demand and supply. So sometimes their demand will be more. Sometimes their demand will be less, right? So these are called as the cyclical stocks based on the demand and supply. Okay. Defensive stocks.
No, sir.
We can call it as a FMCG, right? Fast moving consumer group like HUL, ITC, right?
Okay.
Kind of groceries, the companies which are giving grocery items, right? Because groceries are in use all the times. Whether there is a recession or no recession, people will keep on using the groceries, right? Like atta, dal, chawal, doodh, dahi, all these things. People will continue using it, right? That is why this sector is called as defensive stocks, FMCG, fast moving consumer group.
Okay. All time in use.
All time in demand, right? All time in demand.
Okay.
It's not like that. See, if we are eating chawal, roti, food, we have to eat all the time, right? It's not like that we can stop for 3 months and then start again, right? We have to eat continuously.
Yes.
So that is why they are called as defensive stocks, right? Speculative, any idea about speculative?
Speculative is again, I thought that would be something like cyclic only. Maybe seasonal.
They are kind of manipulation, we can call it as a manipulatives. Because there are some small companies which are being manipulated by operators and big players, right? Because they have very less percentage of equity in the market, maybe like 10 to 15% only, right? Because they have very less stocks in the market. So we can term those companies as speculative, like that, right? Fine, this is clear. Any doubt in this slide?
No, sir.
Okay. So I think we should keep it till here today. Okay. So how do you like the class? How do you feel? Work or how is it?
No, sir. It was productive and what to say, something new to learn.
Okay.
So it was nice. but till now it's going theoretical as you told. And
yeah. First you have to learn theory, then only you can apply those concepts in practical, right?
okay.
So today I have taught you only about the basics, and from the next class we will talk about the technical analysis, how to do analysis, right? How to analyze a stock, what all things we have to check in a stock in a specific company. So we will talk about some use cases, some case studies, and then after that we'll go to practical thing.
Sure, sir. And regarding the fees, so which number are we supposed to send?
You can pay to ma'am's number. You have ma'am's number, no?
Yes, sir.
You can pay to her only.
Okay, sir.
Okay, and you can share me your email ID or just give me the number. Do you have a number?
My mother's number.
Okay, you are not using number. You don't have any mother.
No, not for now, sir. But I'll be using this number.
Okay, just give me the number so that I'll. If you need anything or if I want you to check anything, then I can at least send you message, right?
Should I tell you?
Just tell me the number.
988
988
67
67
29
29.
526.
Yeah, I have this number saved on the name of Anuradha.
Yes, sir. Yes.
Yeah, I have. Okay, fine. So now I'll save on your name. Okay.
Yes, sir. And email, should I be?
Just send me on WhatsApp. Then I will share the link of this recording to you.
Sure, sir. Okay. To ma'am's number or your number.
I will just send a hi on the same number. 1 second.
Yes.
Okay, I have sent you hi message, so you can reply me your email ID on the same number. Yeah. So this spelling is correct, right? Your name spelling is correct, no?
Yes, sir. DHMA. Yes, sir.
So you can send me your email address, and then I will share the recording with you. Okay. And
yes, sir.
Meanwhile, you can try to explore those two websites, BSc India and NSC India. And the next class we can talk about your doubts and all that.
Sure, sir.
Okay. So next class, when do you want to do the next class?
Maybe alternative days would be fine, sir.
Okay. So now on Tuesday.
Yes, sir.
Okay. Timings. You can message me timings. What time?
Anytime, sir. Or in the mornings, 11 to 12, as you told, you will be fine.
Yeah. 11 to 12 is fine.
Yes, sir.
Okay, then we'll meet on Tuesday, right? Tuesday, 11
yes,
o'clock. Okay, fine then. Thank you. Bye.
Bye, sir.
Bye.
Good morning, sir.
Good morning, Deep. How are you?
Fine, sir.
Background noise.
Yeah.
It's a fan, right? The fan, na?
Oh, cooler sound, sir.
Cooler, okay.
AC sound.
Okay. So, do you have any doubts from the previous session?
Not really, sir. I was looking into the previous video only which you had sent. It was simple. It was all about making money, how to invest when you start getting your money, like save it and then invest 30%, save 20, and then use 50% of your money.
Okay.
All of that, and types of stocks, as you told. It was clear.
Okay. So, did you get a chance to explore those websites?
Yeah, sir. I did have a short. I saw that bit, but it was all about history and all of it. But when I went to the practical part, it was all in the graphs, all of it. And the amount which was in the peak time, all of that. So I didn't really get that.
Because all the trades has to happen to take the data from those sites only. We have to review the data, we have to check the data, we have to analyze the data from those websites only. So that is, those two sites are basically the encyclopedia of trading and investments.
Okay. And sir, you had sent me a link of that Kotak Demat account.
You can.
I got it done, sir, and I mean, they told it will take some time for verification.
1 to 2 days they will open it and they will share you the details, username and password.
Okay, sir.
One second. So do you know about the finance rules?
Finance rules, no, sir. It was there in that NSE.
No, it is not there in that site. But there are certain rules that you should remember. I'll just share my screen. You can note down those things because it is important to remember that. Okay. So these are basically the 9 personal finance rules that everyone should know and everyone should try to follow it. Right.
Okay, sir.
Whether as a child or as an adult or whoever it is, he should try to follow these rules, right? So first rule is about rule of 72. So what rule of 72 says that how many years it will take for your money to get double, right? In how many years your money will be doubled based on the interest rate or based on the return you will get from different asset class, whether you are getting it from FD or you are getting from stocks or you are getting from mutual funds, whatever it is. So the rule of 72 says that the formula is 72 divided by the interest rate. Okay. So means if a specific asset is giving you a 8% of interest rate per year, then it will be like 72 divided by 8. And how much it will be? 8 9 is 72, right? So 9 years, 9 years it will take to double that money. If you have invested 1 lakh in a fixed,
so double that. Okay.
So 1 lakh will become 2 lakhs in 9 years. Okay. So same thing if you see from the stocks perspective, normally the minimal return is around 12 to 14%, which is the safest return every year from the stocks. And if you think about the mutual funds like that, then in that case you can consider like 72 divided by 12. So that will be around 6 years. So your money will be doubled in 6 years. So this is how you can calculate, based on your goal and target, you can calculate how much your money will be after certain number of years, right?
Okay.
Let's say after 4 years you plan to have like 5 lakhs of money or some goal is there in your mind, and so based on that you have to start the investing based on the return you are getting from that asset class. So this is how you have to plan.
So the current rate is 12 to 14%.
Normally, which I have seen based on the historical data and all, from past 20, 25, 30 years like that, I have seen that the mutual funds or the stocks which are large cap, right? We spoke about the blue chip stocks now. So those stocks normally give 12 to 14% return per year like that. Okay. So you need to remember this whenever you are planning to find your goal or target. So you can use this formula to calculate those things.
Okay, sir.
Second rule is rule of 70. So this rule of 70 says that based on your inflation, how soon or how long it will take to half your money. So this rule was to double your money, right? So and this rule is like
Half your
it will take to half your money, right? Because based on the inflation and all, right? So like rule of 70 means 70 divided by the interest rate means if you are investing in a FD gives around how much interest? 6 to 7%, right?
yeah.
So you have to divide 70 by 60 and based on that you will get the number of years in which your money will become half. Half means the money will remain same only but the value of money will become half, right? Let's say the value of money 5 lakhs right now, okay? And you have invested in a FD which is giving 6% of interest every year, right? So 70 divided by 60, how much it will come?
Around 9 something.
9 years, right?
Yeah.
Not 9 years. Actually, it is 6 now.
Okay.
11.5 or something like 12, right? It will come like that. So in 12 years, the value of 5 lakhs will become 2.5 lakhs.
Meaning so
whenever you are going to spend in the market based on the inflation, it will, let's say something you are, let's say you want to buy a flat right now, which is costing around 20 lakhs, right? Okay. Then after 11.5 years, that flat will cost you 40 lakhs. The value is increasing in terms of asset, but in terms of money, the value will decrease.
Okay.
You have to spend more actually to buy, if you want to buy anything like asset or flat or if you want to see the fees structure, like all those things, the money, the value of money will become half.
Okay.
You have any idea about inflation?
A bit, sir. I mean, like inflation is where the currency price goes top and so does all the economic things go top, like groceries, all of it also.
So inflation is basically a general increase in price and a fall in because these two are inversely proportional. Once the inflation goes, the value of money will decrease like that, right? So here also we are considering the inflation in the formula. It is not showing you, but based on the inflation, this will decrease your money, the value of money, right?
Yes, sir.
Right. Fine, this is clear now. Any doubt in this?
I got that rule of 72 perfectly, sir, but not this rule of 70.
Okay, one second. Let me explain you with an example. One second. Okay, so let's say right now you are spending 1,000 rupees per day on some kind of items like grocery or like to buy something else, right? Like daily items. Okay, so this rule says that after that much of years, you have to spend 2,000 rupees per day because based on the inflation will increase, right? So based on that, you should be spending double of that money after 10 years, 5 years or 10 years. So that is the value of money is decreased, right?
Yes, sir.
earlier you were using 1,000 rupees to buy the same items, and after certain years you are using 2,000 rupees to buy the similar kind of items, right?
Yes.
So that is why you should invest in a place wherein you are getting a return more than inflation.
Okay, sir. Got it.
So let's say currently if the inflation price is, let's say, 6 to 7%, then you should be investing in an asset which is giving the return more than that. Then the value of money will not decrease. But if you are investing in an asset which is giving you less than inflation, then the value of money will decrease. So it works like that.
Okay.
Now is it clear, or still you have some doubt in this?
Yes, sir. I got it.
Right. So it is basically like both the rules, you should remember it. Okay.
Okay.
Third rule is 4% of withdrawal rule. So this says that withdrawing 4% of your retirement savings annually, right? Annual withdrawal should not be more than 4% of total savings. So let's say you have some lump sum money of 50 lakhs. Okay. And the person want to retire. Once the person retires, he doesn't have any other income, right? So he want to generate some income from this corpus only, right? Because if he doesn't invest, then the value of the money will decrease, right? So he has to invest somewhere wherein he is getting more rate of return. So let's say he has invested 50 lakhs in some mutual fund which is giving 12 to 4% of return, okay, per year. So the maximum money he can withdraw every year is 4% of 50 lakhs.
Okay.
Right. So if he withdraws 4% of this money, then your return will reduce, right? Because here you are getting 14%, and now you are withdrawing 4%. Now your return will reduce to 10%, approximately, like that, right? So you should not withdraw more than 4%. So this rule says like that. So 4% will be approximately 2 lakhs, right?
Okay.
Fine. Next is 100 minus age rule. So
what if we more than 4%, sir?
You can withdraw it. That is fine, but the money will not increase like that, because you are withdrawing, let's say, 10%. Then then your money will grow only at the rate of 4%.
Which is very less. Okay.
It is very less, right?
Okay. So with the 4%.
Because you are not able to beat the inflation at 4%, right?
Okay.
Inflation is 7%, right?
Okay, got it.
So that is why this rule says that you can withdraw only 4% of percent part of that income
annually.
Right?
Yes, sir.
Okay. So the next rule is 100 minus age rule. So this rule says you like how much percentage you should invest in equity. So what is equity? Stocks, stock market, mutual fund, like that, right? So there are two types of things. One is equity, other is debt. So debt is like basically the government bonds or corporate bonds in which the risk is very less. So they are giving you a specific fixed rate of return like FD, right? 6%, 7% or 8%, like that. But equity returns are based on the market condition. If the market goes up, equity will give you more return. If the market goes down, equity will give you less return. So it is totally based on the risk and reward thing, right? So this rule says that based on your age, you should invest certain percentage in equity, and remaining percentage you should invest in debt fund, right? So let's say this says that 100 minus age, okay? So let's say your age is 25 years. So 100 minus 5, 75. So whatever money you want to invest in the market, 75% of that money should go in stocks or equity.
Okay.
Let's say you want to invest 1 lakh. So 75,000 should go in equity, and remaining 25% you can put it in debt fund or savings account or FD, something like that.
Debt fund means we are giving debt for
No, it's not like that. That fund means they have certain kind of bonds, government bonds, corporate bonds, and all those things. It is similar to fixed deposits.
Okay, they'll give you a certain rate of interest every year.
So that I will show you later, like how many types of bonds are there. But you can just now for consider like it is certain percentage. Yeah, तो चाबी दे देना. Okay, this is clear.
Yes, sir.
So let's say if my age is 45 years, right? So 100 minus 45, 55%. I should not invest more than 55% in equity.
Okay.
Right. So this rule you can remember, because see, the lesser is your age, the more risk you can take. The more is your, you should take less risk, because as I told you that stocks are very risky. It is based on the return is based on the market condition. If the stock market goes up, you will get good return. If the stock market goes down, you will get less return, right? So the risk will be more.
Okay.
So based on these rules, some people will do financial planning. See, if some persons will come, they want to do financial planning, right? So we have to use this rule also while doing the financial planning of a person.
Okay.
Fine. Then is 10-5-3 rule. So this rule says that 10% of equity provides expected returns for different asset classes, right? So this says that 10% of the equity, 10% of return from equity, 5% return from debts, and 3% from the saving account. So this is what the minimum returns you should get it, right? So this rule says that. But I am talking about 12 to 14%. I was talking about 12 to 14%, right?
Yes, sir.
So that is a maximum, but this 10% is a benchmark.
Okay.
Yeah. So this 50-30-20 rule. So this is like 50% you should spend on needs, 30% on wants, and 20% on savings. Next is 6x emergency rule. This is basically for the emergency fund. How much fund you should save it for your this thing, right? So this 6x means 6 times your salary. Whatever money you are earning from salary or from anywhere, you should have the 6x of that particular amount in your emergency fund. Okay.
6 times of that salary amount in your savings fund.
In your emergency fund.
Emergency fund. Okay.
So that means 6 months at least.
Okay.
Indirectly, you can say that 6 months of the fund. Let's say if you are earning 50k per month, right? Then you should have 50 into 6. 3 lakhs in your emergency fund.
Okay.
Then is EMI rule. So this rule says that keep loan EMI under 40% of your income.
Okay.
Some people will take more percentage of EMI and they don't follow this kind of rule, right? So based on this rule, you should try to take the EMI considering this rule. Let's say your income is 1 lakh, so your EMI should not exceed 40k.
40,000. Okay.
Life insurance rule. So this is get at least 10 to 15% coverage of your annual income. If your annual income is 10 lakhs, then you should take a insurance of 10 lakhs into minimum of 10 years. 10 lakh into 10.
Okay.
So these things are very important. Once you start your job or once these things, once you start your career, you should remember these. And these rules will keep on coming in your life once you start your career.
Okay. So, and regarding that emergency rule, initially when we start earning, how will we have